Brad Williams, Frugal Finance. I talk a lot about mortgage. I will continue to talk a lot about mortgage. One particular area of frustration for people is understanding an adjustable rate mortgage and the structure or the terminology or the mechanics. I'm going to go in briefly and explain a little more about adjustable rate mortgages. What are the index and the margin and how do they work in the past? Okay, just an FYI, I used to own a mortgage company for, for a long time. Very successful, but with anything, you make money, you have dreams, you close that operation, you start something else. But I was a mortgage broker for 15 or 20 years, something like that. Long time. I went through the 2008, 2009 mortgage meltdown. And the biggest problem there were these adjustable rate mortgages. And they had these no income, no qualifier. You just sign your name, literally sign your name. You have a decent credit score. I have a social security number. Really, that was it. And people were going just crazy with these particular products. And subsequently, all good things come to an end and everything blew up. What the sweetener here was, and at the time, interest rates were about 6.5%, but Countrywide, the lovely folks at Countrywide were introducing these zero startup rates or 1%. Here, we're gonna throw in this 1% adjustable rate starter rate. You're gonna be locked in for 6 months. But given that the industry at the time, and it was a hot industry for 2005, 2006, you had every sleazy person in the world working as loan officers, and they were making way too much money, and they were misdirecting individuals. They're going, yeah, you can buy this house, your interest rate is 1%. They're not lying. They didn't tell you that it was subject to change in 6 months. Then it would change to these just absolutely ridiculous, and it's called the index and the margin, and I'll get into that here in a second. Subsequently, after the meltdown, you're going to have two names you're going to hear me talk about. You're going to have Fannie and Freddie Mac. Those are conforming loans. In other words, they have set guidelines. It's hard to say whether Fannie and Freddie Mac, they used to be quasi-government regulated financial companies. Today, I don't know what they are. Sometimes they're regulated, sometimes they're not. But anyway, just think about a nice, clean package deal that is underwritten. In other words, it's approved by Fannie and Freddie Mac. What does that mean? You will sell your loan to Fannie and Freddie. They package it up and then they sell it to Wall Street, and Wall Street then sells it to institutional houses, okay? Mutual funds, not mutual funds, but money managers that are dealing with fixed rate products. But part of the package there was, or the newer deal was no income, no qualifier kind of deals, no more. We're going to stick with conforming type adjustable rate mortgages. Here we are, and this was as of April 2024. And here we are. The hottest subject now is private credit. Now, I'll have videos on that, or if I don't already have them, I will produce them. Private credit is basically will be a non-conforming loan. What does that mean? That means they will probably come out with what they call teaser rates. These are non-conforming. They will, the likes of BlackRock. BlackRock just spent $12 billion buying one of these groups. You're going to have Goldman, B of A, Morgan Stanley, JP Morgan, the banks, and so on and so forth. They're all going to dive into this because, like anything on the technology side, AI is the hot topic this week. And then in terms of the financial sector, you're going to have this particular structure, but in a private market environment. And guess what? The consumer's going to get screwed again. Why do they do this? Why does Wall Street do this? Because they don't like regulation. They want to be able to persuade the average consumer into a make-believe situation so they can take advantage of the individual. And it's a repeat, and it goes over and over and over again. With that being said, take all of this information and use it in terms of evaluating any particular finance-related product, because there's going to be some critical wording. And again, you get the lawyers involved. They're going to provide something in writing, terms and conditions. It's probably going to be this 16-page friggin' document in 0.05 readability. You'll have to do this in order to be able to read the damn thing, enlarge the page. I'll get to the specifics here. For an adjustable rate mortgage, the index is an interest rate that fluctuates periodically based on the general market conditions. The margin is a number set by your lender when you apply for your loan. When your initial teaser rate expires, the index and margin are added together to become your new interest rate, subject to any rate caps. All right, so I'm going to go down and I'll try to explain this thing. With an adjustable rate mortgage, the initial teaser rate is generally only for the first few years, and then it begins to adjust periodically. Once the rate begins to adjust, the changes to your interest rate and payments are based on the market, not your personal financial situation. To calculate your new interest rate when it's time for it to adjust, lenders use two numbers, the index and the margin. The index plus margin equals your interest rate, subject to any rate caps. So there's three components here. You have your index. There used to be what's called LIBOR. LIBOR is no longer a viable instrument. Why? Because it was manipulated. There were crooks out there, and they manipulated LIBOR to the point where they were making a lot of money manipulating. Who are they manipulating? The government, literally. So now we have, it's called SOFR, and it's tied to a particular index. Or, well, you could tie it to the 1-year U.S. Treasury bond. Oh, it's actually a bill. But you're going to have some type of index. So let's just use the 1 year. So basically, the 1 year was last year, it was at 3%. The previous year, it was at 2%. And the year before that, because of COVEX, it was at 1%. It's volatile. And I should have a chart here. I don't know why I don't. To show you. Anyway, on average, it's going to float around, and right now I think it's at 4.2%, somewhere around there. It's going to move around it moves around every single day. So the question you ask yourself is, where do you think interest rates are going to be long term? Well, the 1 year is probably average 5.5%. Then you compare that to the fixed rate. So you look at the fixed rate, and right now, what is it, 6.5%? I don't know exactly. Again, I don't follow it that closely any longer. I'm just throwing these numbers. They're going to be close, 6.5, 6 7/8. And again, it fluctuates on a daily basis. Here, that's your starting point, your index. Then you have a margin, and this is predetermined by whatever terms you set with the lender. So this is shoppable. The index, not so much so. But this margin, every lender has a margin. So you can shop this around. And then what's critical here is, you see this teaser rate? Ignore it. Ignore it, all right? You remember I said there were, pre-2028 meltdown, there were initial teaser rates. They'd throw in, literally, they would say, well, 0% for 3 months or 1% for a year or something like that. Well, here today, and I could link to another source and we could see whatever that is. But go online and see what the current index is, or shop the index and see what it's tied to. They don't show anything here. They're not using any particular index. So we're just going to use the 1 year for simplicity. But it could be some hybrid of LIBOR. There is actually a LIBOR Europe still, and that's the London Index Borrowing Offering Rate, LIBOR. Now it's the SOFR is, why don't we take a look to see what the SOFR rate is? Right here, I just went to Google and just put in SOFR, and it's the Secured Overnight Financing Rate, which replaced LIBOR. So as of December 16th, as of 2 days ago, the secured financing offering rate was 4.65%. If you want more information, you can just go in and put Secured Overnight Financing Data Rate, or SOFR, and you will get more information. I'll probably have a video, or I might have a video already. Anyway, let's get back here. It was 4.65%. That would be your starting rate plus a margin. Let's just say the margin is 2%. You add the two together, and that would be 6.65%. You look at that in comparison to, let's say, the 30-year rate. So let's take a look now at the 30-year conforming rate. And as of today, December 18th, the interest rate for a 30-year fixed mortgage rate in California is 6.71. I don't know how accurate this is, but let's just go with it. So we were looking at 6.65 versus 6.71. Not that appealing, from my opinion. I would never ever look at an adjustable rate. They need to be about 1.5% lower to be attractive to me. I would always stick with the most conservative route. I would go, if I was looking at buying a property, buying a house, I would always look at a 15-year mortgage. I know you're going to go, I can't afford it. Yes, you can. You can. It's called forced savings. In other words, you throw out all that garbage that you spend your money on. In other words, you go to the restaurants way too often. You buy stuff you don't need. You go on vacation and you spend way too much money. And in the back drawer, you're thinking, I can't afford a house. Well, you can't afford a house. If you're an average individual working for a Fortune 500 company, collectively you and possibly your partner or spouse are making $200,000 a year. Just redirect your money and avoid one of these adjustable rate mortgages. The first time I bought a house, I got stuck. I got swindled by this horrible lending operation. And this was before I started my mortgage company, and it was the motivation to get into the mortgage industry. It was one of these horrible indexes with the margin, and then you had these negative amortization clauses, so on and so forth. Well, after a year, I said adios to that particular program. It cost me money, but in the end, I learned a lot. I would avoid adjustable rate mortgages at all costs. The index is an interest rate that fluctuates with general market conditions. What does that mean? You see this index? That was SOFR. It changes on a day-to-day basis. So perhaps, depending on if you elect to go this route, you're going to have terms. And your terms say, well, after every 6 months, we're going to readjust that. Fine. Good or bad? Well, in a rising interest rate market, it's horrible. But in a lower interest rate market, it's favorable. You have to take that risk. You have to step up and go, well, I think interest rates are going to go lower. Well, then you have that option. On the other hand, if interest rates move higher, let's say they went from 4.65 to 7.5, that's 3%. That is a huge chunk of change that all of a sudden your cash flow is going to be redirected to paying your principal and interest, mostly interest. You need to know the mechanics here, the index. Then you're going to have the margin. This margin could be, again, this is where you need to shop for a loan. Now, sadly, only 13% of people shop loans. Why? Because they don't understand the index and the margin and all this other stuff. So you could see something as the margin could be 1%. It could be 3%. I've seen some really nasty loans out there. So really pay attention to this index and the margin. If it's a very volatile index, for example, if you took a 3-month treasury and it's pretty volatile. And again, the language, they say, well, we can index it to the 3-month. You're going, well, does that mean it changes every 3 months? No. You're going to have an adjustment at either a 6-month period or a 1-year period. You have to read the language, and that's what gets complex because you're dealing with a loan officer who could be a little shady. The industry is known for its low standards. Now, fortunately, you have more control using online app. In the past, this is how old I am, we had very few options in terms of online capability. Everything was face-to-face. Now you can conduct all of this online and you have a little more control because you can read the information and you're not sold up by some slick mortgage loan officer who wants to be your friend. Okay, so just be very careful. You need to understand all the moving parts here. So then you're going to have a cap, which is based off this index. We use the 4.65 as a starting point. There could be a cap. The cap could be 5%, it could be 5.5%, it could be 6%. Take the 4.65%, and we're just going to use 5% for simplicity. Add 5. So now we're at 10.625. If interest rates go up, that is the worst case scenario. You're capped. Why they use the word cap. You cap it at 10.65%. Now, what you need to do is determine, in a worst case scenario, what would happen if interest rates skyrocketed? For who knows what reason, whatever. If interest rate went to 10.625, are you going to lose your house? On the flip side, here's the And here's the double-edged sword, is the lowest this could go, and they're going to have a base, okay? And the index can't go any lower than 0. You can't go negative. And that's the double-edged sword, is it can go up to 10, but it can't go any lower than 0. And most likely, they'll put a floor. It's called a floor. You're going to have a cap and a floor. They'll probably put a floor at 2% because there's not a lender out there that's going to work for nothing. You can see the disadvantages of adjustable rate mortgages. I don't like them, but some people will use these for rental properties. And again, I'm not going to say if that's smart or not, but here's an example of the index, and it changes. Now, your lender decides which index your loan will use when you apply for the loan, and these choices generally won't change after closing. Okay, you're going to be stuck with this particular index, and the margin won't change. These two components added together will be your rates. So if the index today is at 4.625 and the margin is 2%, you can just add those two together and it's going to be 6.65%. Not very appealing, as I mentioned earlier, because this 30-year is at 6.71%. Now, you know with the 30-year, it's going to be fixed for 30 years. But this adjustable, if you think interest rates are going to go to 2%, well, that's your option. The margin is the number of percentage points added to the index by the mortgage lender to set your interest rate on an adjustable rate mortgage and after the initial rate period. So in other words, after this teaser rate disappears, you're going to be subject to the index plus margin. The margin is set in your loan agreement and won't change after closing. The margin amount depends on the particular lender and loan. Again, you need to shop. You need to shop and you need to read the language. It gets confusing and I can see why. Because they'll listen to or they'll see a teaser rate and they're going, hey, look at this. It's 2%. Let's go for that. Hopefully you realize that if something looks so good that it may be too good, well, a 2% loan in a 7% environment just doesn't make sense. So then you need to ask some questions. Why does this look so appealing? And then you're going to go, oh, that was the teaser rate. They have this thing called an index and a margin. Well, let's try to figure that out. So then you look at, and it's at 4% and 2%, so it's 6%. And then you're going to go, well, all right, that makes sense. But why do they call it an adjustable rate mortgage? Well, because it adjusts based on this index and the reset rate. Reset rate, this index could be 3 months, 6 months, 1 year. Fully indexed rate is equal to the margin plus the index. Margin and indexes are two of many terms that determine your monthly payment for an adjustable rate mortgage. It's also important to understand caps, carryover, and other terms. If you're considering an adjustable rate mortgage, check this out. It's called the Charm Book. Let's take a look. Here it is, 13 pages. I have a video on this. I'm going to go through and I'll explain this piece by piece. But this is helpful. I'll leave a link below or just do a search for adjustable rate mortgages. If it doesn't show up, it's just on the to-do list. My suggestion is link to this particular page. You can see that I just went and I started clicking these links. They're helpful. Down below, you're going to see other information. It's going to lead to more information, which is going to lead to more information. The better educated you are, guess what? It just makes the decision-making so much easier. Leave any comments. Let me know what you think of these margin loans, all right? Comment on whether you've had a margin loan in the past or you're thinking about it, and we'll let other people comment on it, or I'll just give you my opinion. Brad Williams, Frugal Finance. Thanks for watching. See you soon. Williams out.